Welcome back. You're watching Buy Now, Sell Now on ET Now, and today is Women's Wednesday. And on this week's edition of Women's Wednesday, let's take a closer look at the power of financial independence. My colleague Mansi Dave caught up with Ekta Gala, who's the dealer and fund manager ETF at Mirae Asset Mutual Fund, who shares the to-do list for investment for women. What factors should you keep in mind when it comes to ETFs? Here's all the questions answered for you.
Fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this special edition of Women's Wednesday, an investor education and awareness initiative by Mirae Asset Mutual Fund. This is your host Mansi Dave. Our goal here is to help our budding potential women investors in their investment journey. The topic of discussion today is very interesting. It says passively yours. Keep it on track, navigating ETFs with confidence. We are going to deep dive into the technical nuances of ETF, and joining in with me on this topic of discussion is Ekta Gala, a well-known, accomplished dealer and fund manager. Ekta, thank you so much for joining with us and talking on this special topic today.
Thank you, Mansi, for having me again on the show.
So, Ekta, while we discuss various investment avenues and help our potential women investors into their investment journey, there are a lot of technicalities, nuances, and a lot of jargons which we keep on listening. Particularly when we talk about ETF also, there are a few technicalities which we keep listening in, and I think I'll start with that itself. So, what is a tracking error and tracking difference, and how is it connected, and what our investors should understand about it?
So, as we all know, ETF is a exchange traded funds that replicates the index. So, if your index is moving up by 10%, your ETF is tend to move up by that much percent.
Correct.
But it is always there that it will not match up completely with it. There are some technicalities, because of which you'll have a 9.8% return. So, the 0.2% difference of from 10 to 9.8 is your tracking error. Okay, so tracking error and tracking difference are bit, similar but deviated.
Okay.
So tracking difference is on a day-to-day basis that you can track, and which is very simple point-to-point difference. Okay. So if your tracking difference is, suppose you're tracking the index, which is giving you a 10%, and your ETF is giving you, suppose 10.2. So the 0.2 positive difference is your tracking difference.
Okay, so the difference between the index and the ETF.
And ETF performance, the
performance
returns.
of the ETF, correct.
Okay, that is your tracking difference. Okay, so tracking difference is mapped on day-to-day basis or month-to-month basis or year-to-year. Okay, tracking error is how frequently your ETF is aligned with the index. Okay, and how frequently your ETF has been in line with the index. So, as ETF is, a passive fund, it has, his only job is to, match the index. Okay. So, when there is any deviation from that, that is your tracking difference on a day-to-day basis. And over a period of time, when you see that point difference every day or every year, and that standard deviation, if you remove, that is your tracking error.
Alright.
Okay. So, that it eats up your return a bit. So, if you have a smaller deviation, that is very good for your fund, and if you have a higher deviation from your index, that is your higher tracking error.
Kind of you're moving away from the index.
You're moving away from your index.
Okay. So, Ekta, why are we discussing the tracking error and the tracking difference, and what are the reasons behind these two concepts?
So, your only purpose of, investing into ETF is that you want to match the index.
Okay.
Correct? So, there are many, factors that because of which, you're not able to 100% match the index. There are, you have your expense ratio, you have, management fees, tracking error, you have a cash drag, you have a dividend that will be redeployed. So, if these, parameters are not in place, okay, there is always a 0.5, 0.2, 0.3 difference which, tend to occur into a fund. Okay. So, if you're not up to the mark, you tend to get that much less return from the index. Okay, so that deviation is, can be positive side, you can over benchmark, but as a passive fund, it has to be in line with the index.
So, Ekta, we can maybe say that tracking error and tracking difference are kind of parameters which will help analyze the performance of an ETF.
Yeah.
Or maybe one of the features which can help analyze the performance of the ETF, right?
So, yeah.
Okay. Again, how crucial is a factor in tracking difference when going in for an ETF? So, how much should we consider this feature while you are, considering an ETF, and If yes, what all things should one consider while having a look at the tracking difference?
So when you track a particular index or an ETF, when you are invested into ETFs, your main thing is that it should give you the return that your index is providing you.
Okay.
Okay. So that is one of the features because of which you will always tend to compare ETFs over different ETFs or indices. So when you compare and if you have a tracking difference and a tracking error in place, okay, and you have to always check that because that is how much return you're getting less from the index. Right. So that is a crucial part because that will signify you how far your fund is from the index or how close are you on everyday basis with the index. Okay. So that is a very crucial factor when you factor in tracking difference or a tracking error. Tracking difference is very easy. On everyday basis you can just check how far you are from your index or how close are you to the index. If you're closest, that's the best ETF you can go for. If you're far, that means there are some issues because of which the ETF is not being able to perform with the index.
And you're going away from
you're going away from
that's a concern in itself. Okay. So this is one, like tracking difference and tracking error. But apart from this, while we are considering ETF, what are the other parameters which will analyze the performance of the ETF?
So one of the feature apart from tracking error is your expense ratio. How much more are you paying from your return to the management fees or as other expenses that is involved.
Correct.
Okay, that is one of the features. The second features that always be that how much portfolio, since the ETFs are disclosed on the website of every mutual fund, how much is the cash drag that that much part you're not invested into ETF.
Right.
So that is one of the concern that you can say that much you're not invested, that's why your return is a bit lesser than that much.
Correct.
The third parameters will always be whether are you liquid enough in that ETF where you can buy and sell. If you have supposedly an ETF which is a very niche ETF, whether can you sell it? Do you have that kind of liquidity on the exchange to sell it? So if you're selling it beyond from your INAV, since in ETFs you always have a real-time basis on every website of a mutual of an AMC. Okay, so you can see the real-time prices of a particular ETF, and if you're not getting that much liquidity, that far are you from selling or buying a stock?
Got it. Okay, so kind of to sum it up, the parameters which one should consider is the tracking difference, the tracking error, the exchange ratio.
Correct. And you have the liquidity.
The liquidity.
Features,
okay.
Yeah.
So with this, we kind of get a deep dive analysis, or maybe it's like a 360-degree analysis of what are the parameters one needs to consider, and literally what all things one needs to consider while you're actually getting into an investment avenue, which is like an ETF, and at the same time the technicalities also. So thanks for that. Literally, I mean, I should say you did explain it in a self-explanatory, in a little easier manner, because the technical nuances like this or the technicalities like this are something which the investors, the potential women investors might find a little difficult to understand. So Ekta, once again, thank you so much for joining with us and helping us navigate through the ETF process.
Thank you so much, Swansea.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.